Hello, sexy people, and welcome to episode 2 of turning 10K to 100K. So, it's been a day since my first episode, and I've clearly haven't done anything in my portfolio. It still stands at 10K. I haven't made any investment decisions yet. So, basically, what I'm aiming to do with this video is to just share my general market outlook for Q4 of 2025 and what I intend to do or what I'm looking out for. So generally, I am bullish on the next 3 months, and I'm looking to deploy capital. And why am I bullish? So number one, this man right here, this guy is gonna take us all to gains heaven with his rate cuts. So if you have noticed, right, the markets have basically um, more or less priced in the rate cuts for September. There's probably going to be a 25 basis point rate cuts, and the market is also particularly looking for more rate cuts towards the end of the year, with some looking towards maybe two or three. So why is this so? Well, this is because I think in the recent Jackson Hole speech, right, Powell went with a different stance than before. So previously he was always saying things like, "Oh, we have to be data dependent. We shouldn't act so fast. We have room to be cautious because we don't know how the tariffs will impact inflation. Is it just really one off? And would jobs be affected?" But recently, he has said that he is uh, leading towards the inflation, cuts being one off, its impact being one off towards inflation, and also the jobs numbers are showing some signs of weakness. So with the Fed's dual mandate of caring about CPI inflation and job numbers, right, this gives him the case to go for a one rate cut. So as you can see historically, right, uh, the S&P 500 after the rate cuts, it would they tend to be more bullish in nature, right? As you can see, 3 months down the line, will be bullish. 6 months down the line, bullish. 12 months down the line, bullish. But it also depends whether the we are cutting into a recession or into an expansionary environment. So if you are cutting into like a growing environment, right, the economy is still booming. This generally leads to stronger stock market returns. But historically, if you are cutting into a recession 3 months down the line, you would see a particular correction in the stock market. So this, I believe, well, if you believe that the how the stock market behaves after rate cuts remains true to some extent, you could go buying into the market if you think there are better times ahead. So and that's also because why I think the stock market will be bullish going forward based on historical trends, and also right. That said, we can't just blindly go along with the market. There are some things to watch. So the main thing that the market is looking out for at the moment, because as you can see, right, when Powell first made his speech and leaned towards like rate cuts, markets didn't immediately just boom, right? It didn't just jump, it didn't just like continue this rally, but it's sort of taking like a cautious stance. This is because I feel number one, the markets have already priced in this rate cut decisions long ago, probably because of Trump being pushy and forceful on Powell, right, for the cut rates. I think it's starting to feel a little bit of that pressure. And whether the market is continue going ahead, right, is whether Powell can confidently tell everyone that there will be more than just one rate cut. So there'll be two to three coming up ahead. So this will give markets certainty to go, allocate their their assets, right, towards more risk on assets like your stock market, your cryptocurrencies, and things like that. So with more certainty, we will see the markets continue rallying. And what will give Powell this certainty? There are two things that I mentioned earlier: the Fed's dual mandate. Number one, the job numbers, whether you see like the tariffs continue to impact on a weakening economy. You're seeing more job cuts, more firing, things like that. So the Fed will cut interest rate to help boost the economy. And number two, CBI. So whether inflation will continue to be like gradually declining like how it is now, and if the tariffs impact on inflation is one off. So the best case scenario, we see a weakening job market and subdued inflation. So this will give Powell the reason to cut more, and the markets will continue rallying after. So I think it's very important to track these two figures over the next few months. So these numbers come out every month. You can track them on any economic calendars website like Forex Factory and things like that. Yep. And number two, right, is to make sure that Trump and Powell are continuing to be aligned for now. So at the moment, they are right. They are showing some uh, bromance for now, but the Fed being an independent institution, it should be free from political influence. So if the data starts to show weakness, and then you see both of them starting to butt heads again, this is where it could create some form of uncertainty in the markets, which I think investors do not like, and you would see volatility and maybe even some correction and pullback. Number two, right? A reason why I'm a little more bullish towards Q4, right, is seasonality. So if you look historically, September is a month where it tends to be weaker. So I believe this gives us a buying opportunity. And October, November, December, they tend to be a lot more bullish. So you got your Christmas rally, things like that. So if the market indeed does deep in September, I think it's a good time to load up on longs, especially that's what I'll be doing into the year end rally. So historically, I think it presents a good buying opportunity for us to go long to the year end rally. But there are some things that we have to keep a lookout for, which is valuation. So if you look at this chart here, right, US stock valuations has hit an all-time high, way higher, well, slightly higher than the previous dot com bubble um, peak valuation. But I think there are some things to consider here besides just looking purely at valuations, right? Number one, back in 1999, I believe all these new websites, your internet companies, a lot of them are actually not generating value compared to what the companies today are doing now. So if you look at your Magnificent Seven and your all AI names, they are hitting very strong revenue growth, profitable, strong cash flow generating companies, and they provide a lot of value to basically everyone, right? So another thing is, right, compared now to today as per before, there is a lot more money in the system, right? And all this money typically has to flow somewhere. It probably won't all sit in your savings account. So people are investing more. People are also becoming more knowledgeable about the stock market, which is why it could be a reason why they've been investing, and then it leads to valuation naturally being a little bit more, in my opinion, a little bit more lofty compared to the past, right? So that said, there is still very, very strong and high expectations on these AI companies, especially the Magnificent Seven. Will they continue to grow at its current pace? Will AI start to disappoint? Things like that. It's also a thing to look out for. And also, particularly since the market rebounded super heavily from April's low, right, to where it is now, valuations may take a little bit of a pullback. They may retrace, right? Because if you bounce back up so high, not naturally there will be some correction. So these are some things to look out for, right? I will be trying to time the market, but if you're just a normal investor, you could just buy during dips. I think that'd be a lot more better, and you continue with your DCA since the market has historically proved to go up over time, right? Yeah, like I mentioned earlier, money supply is very excessive. If you look at your M2 chart, which is a proxy of total money supply in the system, it is going up over time. So with rate cuts and your money printer starting to go burr again, right? You naturally see your asset prices inflate. So this means a bull market, right? So what I intend to do, so basically I'm looking to deploy capital on single stock names. Um, there are some sectors that I am particularly keen in, right? Number one is your big beaten healthcare names, so like your UNH, your Novo Nordisk. I believe this may give you some opportunities to go long, especially since your valuations are now pretty low. And I think as a growth investor or someone looking to beat the market heavily, right, you have to be contrarian in your approach. You have to dare to take positions where the mass market is against you, right? So I think healthcare presents an opportunity to do so, and by investing in it, all these big quality names like UNH and Novo Nordisk are very, very strong companies with strong, decent growth, and like industry titans, right? So they can't just disappear overnight. And I believe as their narrative starts to change and it starts to improve, this presents an opportunity to gain outsized returns. Number two will be high growth names that are showing potential, like your ZETA, things like that, which I'll explain more in future videos. So these are the new age companies that take up market share, showing very strong fundamental growth, and also still trading at decent valuations relative to its growth rates. And lastly, it'll be your narrative names. So, for example, like your Reddit, your Nvidia, your Palantir, those are good companies who just ride it out. But once their narrative change, right, I would be looking to get out as well. I'm not gonna just diamond hands everything. Secondly, right, like I mentioned, valuation is relative to growth and expectations. This is particularly true for high growth names that are showing potential. So I always keep this in mind when I research companies and look to deploy capital. And as I mentioned, contrarian behavior to achieve outsized returns is what I'm going to do with your big beaten down healthcare names. And lastly, right, I am also on the lookout for political news, any geopolitical tensions that would drive stock prices down heavily in the short term. So if you look at the past two recent examples of both what's happening in Iran and Israel, unfortunate situation over there, but it did give the market some jitters when it first announced, when all this conflict was first announced, right? And the markets did actually dip, but if you see how fast it recovered. So these geopolitical events are all opportunities to go long. And also, even the tariff situation, right? You see how fast the market did, how extreme it did, and after that, how extreme it recovered. So I'll be on the lookout for this kind of situations to go along. But unless it's world ending, right? Then there's no point even being invested in the stock market anymore. So this, in a nutshell, is my outlook for Q4. Generally bullish. Some pointers to look out for in case anything fundamental changes, right? But I think what's most important in this entire market scenario is how your Fed's going to behave, how it will influence your interest rates decisions going forward, whether it be more or less rate cuts. So that is the biggest factor. And also your AI names, your Magnificent Seven must continue its earnings potential. So that's that. And I'll see you in the next episode where I most likely will share some stocks that I'm looking at my stock list, watch list right now.